Hello everyone, today with MarketXLS we're going to talk about a very famous options trading strategy known as the long straddle option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. It makes it easier for you to turn your Excel skills and market knowledge into profit. In this video we'll be learning what a long straddle option strategy is, how it works, when to use this strategy, what is the range of returns, and finally, we will understand how MarketXLS can help investors to implement this strategy in an effortless manner. This strategy is used when the trader believes the underlying asset will move significantly higher or lower over the lives of the options contracts. It is a strategy which is used by traders when they are expecting a high volatility period of the underlying asset. A long straddle is an option strategy comprised of buying both an at-the-money call option and at-the-money put option with the same strike price and expiration date. Each leg must have the same number of contracts. The maximum loss is the amount of premium collected by buying the options, and the maximum profit can be unlimited if the stock moves sharply in either of the directions. Once implemented, the profit and loss is not affected by the direction in which the market moves. As long as the market moves, a positive P&L is generated. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's the active template. The cells in which the user has to enter his inputs have been highlighted in yellow. So the stock ticker, expiry date, and ATM strike price have to be inputted. Some upcoming expiry dates, the current share price, and the lot size are available for the investor's reference on the right. For the purpose of this video, we'll be using Microsoft expiry date as 19 February and we'll be buying one lot of ATM put option at 245 strike price and one lot of ATM call option at the same strike price. A hedge will be created by going long on both an ATM call and an ATM put option. The net cash flow would always come out as negative since the investor is buying both an ATM call and put option, and hence there will be an outflow in the form of a premium. In this case, the net cash flow is negative $511, which is the result obtained when we add the product of the number of units times the premium on the call option and the product of the number of units times the premium on the put option. MarketXLS has many templates, just like the long straddle option one that you see here, and it refreshes all the data when you click on Refresh All. MarketXLS offers a net payoff table and a net payoff diagram to help the user observe the potential profit and loss at different expiry levels. The user has to enter his inputs of minimum and maximum payoff profile. The table contains the net payoff strategy at different expiry prices. In the chart, the y-axis is the net payoff strategy and the x-axis is the range of expiry prices. Maximum loss occurs when markets don't move, and maximum profits are unlimited in either direction of the market, and they occur when the underlying asset moves in a particular direction. That is all for today. We hope we were able to help you understand how to use MarketXLS for the long straddle option strategy. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.